Welcome back to CEO Money. I'm Michael Yorba, your host, with Mervyn Price. And Mervyn, welcome back to the show.
Hello, thank you.
All right, we've also got a guest host, Russ Filippo, in our office and in our studio right now. Russ is going to talk with our next guest, Ryan Wright, CEO of Fig Tree Capital Ventures. But before we get Russell in on the show, he's also working on investor relations with us, right?
That's correct, yes.
Okay. All right. Please, Murph,
Okay.
introduce our next guest, Ryan.
Great to see you in the studio. Thank you for coming along. Finally, we get to meet.
Thanks for having me.
Great. Ryan, tell us, who is Fig Tree Capital?
Well, Fig Tree Capital is a venture capital firm based here in Texas with a primary focus on direct participation projects. Our projects are designed to create cash flow, tax benefits, and asset appreciation, and we do these projects in numerous sectors.
Okay.
Great. What type of projects and investments are you working with? What investments do you offer?
Right now, we have three separate divisions at Fig Tree Capital. We have an energy division that focuses on oil and gas development in the core resource plays in North America, primarily the Stack and Scoop in Oklahoma. We have an ongoing $20 million fund that's targeting North Texas residential real estate. We're doing property flips, rentals, owner financing. That's been a fantastic project for us. And we also have a partnership that's funding a wireless electricity company. It's a tech company that's developing long-range wireless electricity transmission. So that's definitely been an interesting venture for us as well.
Wow, you're covering all the sectors. That's really good. You're hitting all
Is Nikola Tesla working for you on the last project?
Well, no, it is based on his theories and his science, though. So, we try to offer multiple things because you don't want to be a one-trick pony there. So, we started off oil and gas, but it was a natural segue into other areas.
Let's go back to the oil and gas then. Luckily today we have Russell Filippo with us. He's from Oklahoma and he has a knowledge of oil and gas. And I'm going to pass you across. He may have one or two questions for you, Russell.
Sure. Hi there. And thanks for having me here, Mervyn and Michael.
You're welcome.
What I want to ask you is one of the things that really intrigues me about the approach that we discussed here, during the break, is that you have these deeper wells that you're using that really are targeting some very profitable zones. I think people out there that have been investors in oil and gas, would like to hear something about this and what differs you from so many that are out there.
Okay, well, if you want to talk about the area that we focus in, for the last several years we've been targeting an area in Oklahoma called the Stack and the Scoop. It's by far been the most profitable oil and gas development we've been involved in, and I think it's quickly become one of the hottest areas in the country because of that. It's considered the lowest break-even play in the United States. There's several reasons for that. The wells themselves produce tremendous volumes of oil. It's deep, as you mentioned, so it's very high pressure. Mm-hmm. Obviously that's the first thing you need is quite a bit of oil. But there's a lot of things that other investors that I talk to don't realize, that in Oklahoma there's some factors that are contributing to the economics. So number one, they have a very low taxes on the production. They have a 2% production tax for the first 3 years, which in an unconventional well, that's a lot of the reserves coming out in the first 3 years. So that's a huge benefit. Also, because the Cushing, where all the oil goes and is transported to, is right there in Oklahoma, the transportation costs are very low. In addition, we're getting paid full WTI spot price for our oil, which, in the Bakken Shale, you're getting a $7 to $8 differential right at the wellhead. So that's a pretty big diminishment right there at the wellhead.
Well, that also means that the quality of your oil must be very, very high as well.
It is. In the Stack and the Scoop, it is, yes.
Uh-huh.
And then, a couple other things, as far as just the geographical economics there, you don't have a lot of water in these wells, and that has been a huge expense in areas like the Bakken. Water disposal.
The oil cut is everything, and that's yes.
Right. So you've heard of earthquakes and things like that, but the Woodford and the Springer and these other formations like the Oswego, we're not making a lot of water, so that really makes the production a lot more economical. So if you put it in comparison, we could drill two identical wells, one in the Stack or Scoop and one in the Bakken. And if these wells cost the same and produce the same, just because of those factors, we're double digits higher return-wise in Oklahoma just because of where we're at. So 2% tax versus 11.5% tax is huge.
No, that's great. What is your average, barrels of oil per day on some of these different prospects? I know they differ, but give us just a rough idea of what they might be.
It varies, but you're talking about thousands of barrels of oil a day. I mean, and all wells decline eventually, but the very first well we drilled up here and hit was one of the most exciting wells we've been on. It initially came in at 3,400 BOE a day. So that was a tremendous well for us, and we've hit some pretty huge wells up here. So
That's big.
It
That's
is.
good.
Yeah, it was comprised. BOE is what we talk about. It's barrels of oil equivalent, and that was comprised of about 400 or 500 barrels of oil a day and about 18 million cubic feet of gas a day. Wow. That well has been a great payout for us, and so we've continued that. That was in Grady County. We drilled that with Vitruvian, but we've continued to target this area with. We've got a very specific area that we're targeting because I want investors to know that just because somebody calls you and says it's stack and scoop, you've got to have a company that has the expertise to get you into the core areas.
And somebody with good partnerships.
Yeah.
Right. You want to be involved with the main operators. But guys, Continental and some of these companies, they're oftentimes drilling on the fringes to try to find where the play ends. That's not something you as an investor want to be involved in because you could have a smaller return. You want to be in the core where you're hitting all the best production.
Or like a direct offshoot of something that's very, very good
Right.
as opposed to like a cheap outlying area, yes.
So our geologists have been very good at knowing what to buy and what not to buy. Because oil and gas nowadays, as I was explaining to you earlier, we're not looking for oil. We're not hitting dry hole after dry hole exploring for oil up here. This is real estate based. We know where we want to be. It's just a matter of if we can get our hands on it and get our investors foot in the door with folks like Continental. I mean, our partners, Continental, Devon, Marathon, these are big publicly traded companies. They do very well, but you still want to be in the right place with them.
That's got to be refreshing to so many folks out there that have invested in oil and gas and had that experience of dry hole after dry hole after dry hole. So
Right.
It sounds to me like you folks are on the right track and you're doing the right thing by investors.
Yeah, it's been a fun ride so far, and I think this is the area we'll continue to target because price-wise, $40 oil, $45 oil in this area generates a significant return on these types of wells. So we don't need $60, $70 oil to justify drilling wells because we're, based on reserve expectations in some of our core areas, you could still see 3 to 1 plus at $40, $45 a barrel with some of these wells. The industry's been able to slim down the cost, but again, the way these wells are performing. I just read a week ago, Devon announced a well that came in over 6,500 BOE a day. I mean, these are huge producing wells. And there's a lot of stuff out there on the internet other than what we're putting out. If investors just go research Stack and Scoop, you'll have numerous folks talking about the economics of it and how it's
Ryan,
been
go into
beneficial.
for those listeners who don't understand, go into Stack and Scoop very quickly.
Okay,
What
so
is it?
STACK, in Oklahoma, they like to create acronyms for their oil and gas plays. So STACK means Sooner Trend, Anadarko Basin, Canadian Kingfisher counties.
Okay.
And they're kind of naming the area. So that's a mouthful, so STACK sounds better, right? So the Scoop is the South Central Oklahoma oil province. Now, in both of these areas, you're targeting the main formation is the Woodford. You're targeting a formation called the Springer. Those are scoop formations. In the Stack, we're targeting the Merrimack, and we're targeting also the Woodford. We've got a new development up there where we're targeting the Oswego with the company Chesapeake and a few others. Mm-hmm. Those wells have been tremendous because they're shallower and cheaper, and we're seeing wells coming on 1,000+ barrels a day for a fraction of the cost of drilling the really deep stuff.
So are you doing a fair amount of partnering with bigger companies?
Yeah, that's what we do. I mean, we don't drill or operate. That's not our expertise. Like I said, our expertise is getting in, finding the acreage, and getting those partnerships. And so what our partners are buying is called non-op interest. So everything's defined by an area that says, okay, well, Chesapeake has control or Continental has control. We may come in and buy 5% or 10% of that area, so we can get on those wells and participate with them.
You talked about some tax advantages too when we were off air. I think they might like to hear something about that. I know I could use a lot more knowledge myself in that area.
Yeah, there's several tax advantages in oil and gas investments. The main one that everybody talks about is the intangible drilling costs. So this basically is all the stuff that you can't reuse: labor costs, fuel costs, drilling mud. And it's a massive expense in year one. And so our last two projects had IDC deductions for our investors of 86% and 87%. So if you're an investor and you put $100,000 into a project, you wrote off $86,000, $87,000 that year. So it's a big reduction in your taxable income.
And then the rest is over so many years.
And then you get depletion and depreciation. But oil and gas, one thing I think investors should know is, if you do real estate or commercial real estate, And once you're at a zero basis, there's no more deductions. Oil and gas is the only thing left that you can still deduct your entire investment and continue to get 15% tax-free income for the life of that project. So that's a nice thing also.
The lifespan of these wells that you're talking about, we got about a minute left, so I don't want to cut you off, but I'm sure that's of interest to somebody.
Yeah, I mean, the shale wells, typically what you hear the industry folks say is 25 to 30 years. You can plot some of these on a decline curve once you have enough control data. And, I mean, there's some that'll show 50-year decline curves. But, again, most of the time we're talking about 20, 25 years is what we stick to.
That's pretty good.
Beautiful.
And the declination curve, I understand, is not that steep.
Well, here, compared to other all conventional shales have a pretty steep decline curve, but here it's been less than some of the other areas like the Bakken we focused on. But what you see is in the first 12 to 36 months, you hit a straight line decline. And once you're at that point, it's a very flat 3 to 5% a year decline. But initially, you may have 50, 60% decline in the first several years.
Right, that's normal in the wells. All right, we're going to have to close, Ryan. Thanks. You've been a great wealth of information.
That was fun, guys. Thanks for having me.
You're welcome.
Thank
Real
you.
quick contact information for you, for our listeners.
Well, you could go to figtreecapitalventures.com. You could email us, admin@figtreecv.com, or you can even email me, Ryan@figtreecv.com, or you can call us at 866-894-7309.
All right, Ryan.
Beautiful. Thanks, Ryan.
Thank you.
Thank you, guys.
All right, coming up next on the other side of this break, Brent Nicolation, Next Source Materials. We'll be right back on the other side of this break.